Have you ever felt like you're doing everything right with your money, but you still can't shake the feeling you might be leaving cash on the table? You picked a brokerage. You set up automatic contributions. You're not panic selling every time the S&P dips. By most measures, including the latest Federal Reserve data, just doing those three things puts you way ahead of the average American investor. And yet, there's this nagging question sitting in the back of your mind. Did you actually pick the right company to hold your investments? Today, we're putting that question to the test. We are taking a $50,000 starting portfolio, adding $500 a month for 25 years, and running it through 4 completely different fund categories at both Fidelity and Vanguard. Same strategy, same timeline, 2 different companies. I pulled the historical data and expense ratios straight from their official prospectuses, and by the end of this video, you'll know exactly where the real wealth gap shows up. Spoiler alert, it's probably not where you expect. Let's look at the numbers. Let's back up for a second, because if you're newer to investing, the words index fund might sound more intimidating than they should. An index fund is, at its core, a way to buy a tiny slice of hundreds or thousands of companies at once, instead of betting everything on one stock and hoping you picked a winner. As Vanguard's legendary founder John Bogle used to say, don't look for the needle in the haystack. Just buy the haystack. The fund simply tracks a benchmark, something like the S&P 500, and tries to mirror its performance as closely as possible. Because there's no team of Wall Street analysts picking winners and losers, the costs to run these funds are dramatically lower than actively managed funds. That's the entire appeal. You're not paying someone to guess. You're paying almost nothing to simply own the market and let decades of American economic growth do the work for you. If you're like most Americans saving for retirement, you've probably already got exposure to index funds without fully realizing it. Inside a 401k, a Roth IRA, maybe a taxable brokerage account you opened during the pandemic. And that's exactly why this comparison matters right now. 2 of the biggest names managing that money are Fidelity and Vanguard, and most people pick one almost at random without ever asking whether the choice actually affects their bottom line. Here's the thing that makes this moment different from, say, 10 years ago. Both companies have been locked in a genuine price war, and it's actually changed what's available to everyday investors. Fidelity made headlines in 2018 by rolling out their zero-fee mutual funds, funds that, on paper, have a literal 0% expense ratio and cost you nothing to hold. Vanguard, the company that invented the index fund back in 1976, has spent decades being the default answer to where should I put my money for cost-conscious investors. Both are excellent. Both are far cheaper than the mutual fund industry as a whole. But both are good doesn't tell you which one is good for your specific situation. And that's the gap we're closing today. This is the exact moment many people get stuck. When 2 options both look reasonable, it's tempting to assume the difference must be negligible. But small percentage differences, compounded over 25 years on real contributions, stop being negligible. Let's go back to our starting numbers. $50,000 invested, adding $500 a month for 25 years. If one fund returns 7% and the other returns 6.5% because of a tiny fee difference, that 0.5% gap becomes a $58,000 difference in your final portfolio. That's not a hypothetical. That's just how exponential math behaves. So here's exactly what we're going to do. We're going to pressure test both companies across 4 genuinely different investing strategies. First, we'll look at straightforward S&P 500 exposure, the most common starting point for nearly every new investor. Second, we'll widen out to total U.S. market funds, which include thousands of mid and small cap companies instead of just the 500 largest. Third, we'll look at balanced funds, for the investor who wants some growth but doesn't want to stomach 100% stock market volatility. And finally, we'll head into emerging markets, the higher risk, higher reward corner of the portfolio that a lot of investors either ignore completely or chase blindly. In each category, we're using live, current funds verified as of today, not outdated numbers from 2 years ago. One quick note before we dive into the data. Nothing here is personalized financial advice. I'm not your advisor, and I don't know your specific tax situation, timeline, or risk tolerance. What I am going to do is hand you the actual expense ratios, the real fund structures, and a transparent math model so you can see exactly how the gap forms, and then you can decide what that means for your own money. All right, let's start where almost every investor starts, the S&P 500. Before we get to the categories, I want to walk through the mistakes I see investors make constantly when they're trying to compare 2 providers like this. Because if you avoid these three things, you'll already be ahead of most people doing this kind of research. Mistake number 1. Comparing performance instead of comparing structure. This is where I used to fail constantly when I was first learning this stuff. I'd pull up 2 funds, glance at their 1-year returns, and assume the fund with the slightly higher number was simply better. But here's the reality. If 2 funds are tracking the exact same index, their underlying performance should be nearly identical because they're holding the exact same companies. Any difference you see almost entirely comes down to cost, not stock picking skill. When you're comparing an S&P 500 fund at one company to an S&P 500 fund at another, you're not comparing investment strategies. You're just comparing a fee structure wearing 2 different logos. Mistake number 2. Assuming low cost means identical cost. This trips up even experienced investors. Fidelity's zero expense ratio funds genuinely do charge nothing in annual fees. That's real, that's verified, and it's a legitimate structural advantage. But the moment you step outside of pure index tracking and into something like a balanced fund or an actively managed strategy, those zero-fee advantages can disappear entirely, sometimes replaced by fees that are actually higher than the equivalent product at the other company. You can't assume one company is cheaper across the board. You have to check category by category. Mistake number 3. Ignoring the difference between passive and active management. Here's a pitfall that catches a lot of people off guard. Not every fund that sounds like an index fund is actually passively managed. Some balanced or asset allocation funds use human portfolio managers making real decisions about what to buy and sell. Active management can occasionally outperform in the short term. But according to the latest SPIVA scorecard from S&P Global, over a 15-year period, nearly 90% of actively managed U.S. stock funds actually fail to beat their benchmark. And the worst part? You're paying that meaningfully higher management fee, whether their human manager guesses right or wrong. I bring these up now because you're about to see all 3 of these dynamics play out. In 2 of our 4 categories, you'll see Fidelity and Vanguard going head-to-head with genuinely comparable index funds, and the gap stays razor thin. But in the other 2 categories, the structure of the funds changes the entire conversation. If you've ever picked a fund just because the company name felt familiar, or you just left your money in the target date fund your workplace 401k defaulted you into, you're not alone. That is the most common reason people end up holding a fund that doesn't match what they actually want. The good news is, once you know what to look for, this stuff stops being mysterious fast. So let's get into the actual numbers. Starting with the fund category nearly everyone in this audience already owns in some form, the S&P 500. Here's our setup for every category that follows. A $50,000 lump sum to start, plus $500 contributed every single month for 25 years. That's $200,000 of your own money going in over the life of the investment. We're using a long-run historical average return for U.S. equities, right around 10% annually, which is the documented long-term average for the S&P 500 going back to 1957. And then we're subtracting each fund's actual current expense ratio to get a realistic net return. No invented numbers, just the fee applied honestly. Round 1, the S&P 500. For Vanguard, we're using VOO, the Vanguard S&P 500 ETF, sitting at a still remarkably low 0.03% expense ratio. For Fidelity, we're using FNILX, the Fidelity Zero Large Cap Index Fund. Now, technically, FNILX tracks a proprietary Fidelity index, not the official S&P 500, because Fidelity avoids paying S&P Global's licensing fees, so they can offer a 0% expense ratio. But the performance is virtually identical. Run that $50,000 plus $500 a month through 25 years at a 10% gross return, minus those expense ratios, and here's what comes out. Fidelity's FNILX lands at approximately $1,266,000. Vanguard's VOO lands at approximately $1,258,000. That's a gap of roughly $7,800 in Fidelity's favor. Small but real. Quick American tax warning. If you buy Fidelity Zero funds in a taxable brokerage account, you cannot transfer them to another broker later. You have to sell them, which triggers IRS capital gains taxes. So keep zero funds inside a tax-advantaged account like an IRA or 401k. Round 2, total market. This category isn't about the 500 biggest companies. It's about owning practically the entire U.S. stock market. Fidelity's pick here is FZROX, the Fidelity Zero Total Market Index Fund, again at a 0% expense ratio. Vanguard counters with VTI, the Vanguard Total Stock Market ETF, at 0.03%. Using a slightly more conservative 9.75% gross return to account for smaller, volatile companies, Fidelity's FZROX finishes around $1,202,000, while Vanguard's VTI finishes around $1,195,000. Fidelity ahead again, by roughly $7,400. 2 rounds in, the story is simple. When you compare true apples-to-apples index funds, Fidelity's zero-fee structure gives it a small edge. But round 3 is where everything changes. Picture an investor who wants a fund that automatically blends stocks and bonds so she isn't constantly rebalancing. Fidelity's option here is FASMX, an actively managed fund where a human adjusts the mix. It currently charges 0.51% in expenses. Vanguard's option is VSMGX, a 60/40 fund built entirely out of underlying passive index funds. Its expense ratio is 0.11%. Using a 7.5% gross return, Fidelity's active FASMX finishes around $687,000. Vanguard's passive VSMGX finishes around $748,000. That's a difference of roughly $60,000, decisively in Vanguard's favor. One fund is actively managed and charges for it. The other is passive and barely charges anything at all. If you're holding a balanced fund right now, that $60,000 gap is the literal cost of not checking your fund's expense ratio. Round 4, Emerging Markets. Fidelity's pick is FEMKX, an actively managed emerging markets fund with a steep expense ratio of 0.89%. Vanguard's pick is VWO, a passively managed index ETF sitting at a low 0.08%. Using a 7% gross return for these choppier global markets, Fidelity's FEMKX finishes around $585,000. Vanguard's VWO finishes around $683,000. That is a gap of nearly $98,000. The single largest difference in our entire comparison. Active management costs more, and it compounds against you. So here's the full picture. In the 2 index-to-index categories, Fidelity's zero-fee structure won by around $15,000 combined. But in the 2 categories where Fidelity offered active management, Vanguard's passive index alternatives won by a combined margin of roughly $158,000. Net it all out, and across this entire $200,000 contribution strategy, Vanguard finishes ahead by approximately $143,000. Not because Vanguard is universally cheaper, but because the cost of active management quietly did more damage than most investors would ever guess just by glancing at a fact sheet. So what do you actually do with all of this? Here's the takeaway, and it's simpler than you might expect. This was never really a Fidelity versus Vanguard story. It's a story about passive versus active management, dressed up as a company versus company comparison. When both companies offer a genuine, low-cost index fund tracking the same benchmark, the difference between them is tiny, a handful of basis points that barely move the needle even over 25 years. But the moment one of your funds steps into active management while its counterpart stays passive, that's where real money is won or lost. And it has nothing to do with which logo is on your account statement. If you remember nothing else from this video, remember this one question, and ask it about every single fund you currently hold. Is this fund passively tracking an index, or is it being actively managed by a person making judgment calls? You can find the answer in about 30 seconds by searching the fund's ticker symbol and reading its summary. If the SEC prospectus says it seeks to track the performance of some named index, that's passive. If it talks about a manager selecting securities based on research or analysis, that's active, and you should know exactly what you're paying for that. Here's your action plan, starting today, not someday. Pull up your current 401k or brokerage statement and find the expense ratio listed next to every fund you own. Most platforms show this directly on your account dashboard. For any fund charging more than roughly 0.2%, ask yourself honestly whether it's actively managed, and whether that active management has actually earned its higher price tag through a sustained track record of beating the market. If you find a passive index fund quietly charging way more than a comparable alternative tracking the exact same index, that's free money sitting on the table. Now, a quick warning here. If this money is inside a tax-advantaged account like an IRA or a 401k, moving to the cheaper equivalent costs you nothing but a few mouse clicks. But if you are in a standard taxable brokerage account, selling a fund to switch to a cheaper one will trigger IRS capital gains taxes. Always weigh the tax hit against the fee savings first. And if you're choosing a balanced or target date fund specifically because you want that hands-off simplicity, look specifically for one built from underlying index funds rather than one relying on active stock picking. You can get the exact same hands-off convenience without paying an active management premium for it. None of this requires you to become a finance expert. It just requires about 15 minutes with your account statement and the willingness to ask one uncomfortable question. Am I paying for something that's actually earning its cost? I want to be honest with you before we wrap up. Neither Fidelity nor Vanguard is the villain here. Both companies have driven costs down dramatically over the past decade in ways that genuinely benefit everyday American investors. Both offer excellent, legitimate options depending on what you're trying to build. The real lesson isn't pick this company over that one. It's understand what you're actually buying every single time you hand over your money. Because a few tenths of a percent, ignored for 2.5 decades, is the quiet difference between a comfortable retirement and one where you're constantly wondering if you should have paid closer attention sooner. You've got the tools now. You know exactly what questions to ask and exactly where to look for the answers. If this video helped untangle something that felt confusing before, drop a comment letting me know which fund category surprised you the most. I read every single one. And if you want more breakdowns like this, comparing real funds with real, current numbers instead of recycled examples, hit subscribe, because that's exactly what this channel is built around. Now go check your expense ratios. Your future self is going to thank you for the 15 minutes this takes today.